stop loss orders. Are they a good idea? Should you have them? Should you have stops? And you might be thinking, yeah, of course I should have stops. Yeah, you gotta stop out. And that's not necessarily true. So I ran across this question here. Is stop loss orders a good idea? Just heard about this. Thanks for any information. Okay, so Elmer there asks, about stop losses. And I think it's nice and normal to have a stop loss at the beginning when you're buying shares of stock. Let's say you buy 100 shares of stock, 20 shares of stock, 50 shares of stock, whatever your number is. If the stock is going down, it could actually go down to zero. In these cases, you do want to stop out because the risk is quite great. So if you buy a stock at 80, it pulls back to 70, you could say, hey, I'm stopping out, meaning you get out. That's really what it is. It's to live another day. It's to survive. It's to, preserve capital and wait for another trading opportunity. Now, that's all fine when you're trading and thinking about things at the basic level. However, as things do progress, I think stops are misinterpreted because when you look at things like, let's say, a vertical spread, here's one on CrowdCast CrowdStrike that I did for our Facebook group there. To show you this concept and principle, in these cases, if you're doing things like a vertical spread, this was a debit spread, meaning what you paid. I'm risking 215 to possibly make 285, and I've got 38 days to go on this one. So in this case, a stop is not really necessary because the most I could lose is 215. So if this stock goes down to zero, the most I could lose is 215. So it's predefined. And in fact, actually the same principle can apply to if you're buying a single option. By the way, we could just actually simulate that right here. If you're buying just a single option contract, like let's say you're buying a call, again, in this case too, you probably would not need a stop. Now, yes, you're risking 1775, but if you can't handle that, then you probably shouldn't be trading the single option. Because what people do a lot of times is they pull back, they stop out, and then that stock goes right back in their face, laughing at them because it's, these already have a stop in place because you're trading singles, they kind of decay and they kind of whip you around. So anyways, my point being here is that when you look at stops, it really just depends on the structure of that position on that strategy that you have. So if you're using a strategy like a covered calls or just long investments, dividend type things, then yeah, you probably should have a stop. At the money verticals probably should stop out. Iron condors probably should stop out. Other strategies, maybe like an at the money vertical spread, maybe a butterfly, you actually don't necessarily need stops. So there's different types of trades where the risk to reward ratio is different. And the ones where you don't have a favorable risk to reward, but you have a favorable winning outcome, you probably should stop out of some of those trades. And that is simply because, well, the risk is greater. So that's my take on these kinds of concepts. We cover a lot of this in the options black belt mentoring situations where we go in and I work with you day in and day out, and also in the groups. So definitely check those things out on our website. Otherwise, enjoy the video. Have a good weekend ahead. Make the most of it and trade a bit more. All right. I'll see you next time. Take care.